the Fed's next move could cost you $4,200 a year. The Fed is considering a rate hike to address inflation, and it's crucial to understand what this means for your wallet. In this video, we'll break down the potential impact on mortgage rates, credit card interest, and consumer spending. But first, let's look at what's driving this decision. And the recent rate hike announcements have already started to drive up mortgage rates. For example, a $300,000 mortgage at 4% interest would cost $1,432 per month. But if rates rise to 5%, that same mortgage would cost $1,610 per month, an increase of $178. This could lead to a significant decrease in consumer spending, as homeowners are forced to allocate more of their budget to mortgage payments. In fact, a study by the National Association of Realtors found that a 1% increase in mortgage rates can lead to a 10% decrease in home sales. So, what does this mean for the average homeowner? For instance, a homeowner in Los Angeles with a $500,000 mortgage could see their monthly payments increase by $350. Additionally, back in 2008, the housing market crisis was exacerbated by rising mortgage rates, which led to a surge in foreclosures. Today, with mortgage rates already on the rise, it's essential to consider the potential impact on your wallet. But the part that surprised me most is what this does to your credit card debt. That is next. Think about it. With rising interest rates, the cost of carrying debt will increase significantly. This could lead to a snowball effect, where consumers struggle to make ends meet and debt delinquencies rise. We'll dive into the specifics of how this affects credit card interest in the next section, including a real-life example of how a rate hike impacted a consumer's debt. You'll learn how to avoid a common pitfall that could cost you thousands of dollars in unnecessary interest payments. But credit card interest rates are also on the rise. The average credit card interest rate is currently around 18%, but this could increase to 20% or more if the Fed raises rates. For example, if you have a $2,000 credit card balance at 18% interest, you would pay $440 in interest per year. But if the rate increases to 20%, you would pay $560 in interest per year, an increase of $120. This could lead to a significant increase in debt for consumers who are already struggling to make ends meet. In fact, a study by the Federal Reserve found that a 1% increase in credit card interest rates can lead to a 5% increase in debt delinquencies. To put this into perspective, back in 2008, credit card interest rates were around 12%, and the average American had around $2,500 in credit card debt. Fast forward to today, with interest rates at 18% and the average debt at $4,000, it's clear that the impact of rising interest rates on credit card debt will be substantial. Furthermore, a common misconception is that credit card debt is only a problem for those with poor credit, but in reality, even those with excellent credit can be affected by rising interest rates. For instance, consider a consumer named Sarah, who has a $5,000 credit card balance at 18% interest. If the rate increases to 20%, she would pay an additional $250 in interest per year. Additionally, many consumers are unaware that credit card companies often raise interest rates on existing balances, even if the consumer has a good payment history. But the part that surprised me most is what this does to your investment portfolio. That is next. Think about it. With rising interest rates, the value of your investments could decrease significantly. This could lead to a perfect storm, where consumers not only struggle with debt, but also see their investments decline in value. We'll dive into the specifics of how this affects investment portfolios in the next section, including a historical comparison of how interest rates impacted the stock market during the 2008 financial crisis. You'll learn how to protect your investments from the potential rate hike and avoid a costly mistake that could wipe out your retirement savings. And the impact on investment portfolios could be significant. For example, a study by the Investment Company Institute found that a 1% increase in interest rates can lead to a 10% decrease in stock prices. To put this into perspective, back in 2008, the S&P 500 declined by over 30% due to the financial crisis. If interest rates rise by 1% today, we could see a similar decline in the stock market. Furthermore, a second-order effect that most people miss is the impact of rising interest rates on dividend-paying stocks. As interest rates rise, the attractiveness of dividend-paying stocks decreases, leading to a decline in their value. For instance, consider a consumer named John, who has a $10,000 investment in a dividend-paying stock. If the interest rate increases by 1%, the value of his investment could decline by 10%, resulting in a loss of $1,000. Additionally, many investors are unaware that rising interest rates can also lead to a decrease in bond values, which could further exacerbate the decline in their investment portfolio. But the part that surprised me most is what this does to your overall financial strategy, and that's what we'll discuss in the next section. So, what can you do to protect yourself from the potential rate hike? First, consider refinancing your mortgage to a lower interest rate. Second, pay off high-interest debt, such as credit card balances, as soon as possible. Third, diversify your investment portfolio to minimize the impact of rising interest rates. And finally, consider consulting with a financial advisor to determine the best course of action for your individual situation. Additionally, it's essential to review your budget and make adjustments to account for the potential increase in interest rates. For example, you could consider reducing your expenses, increasing your income, or building an emergency fund to cushion the impact of rising interest rates. By taking these steps, you can protect yourself from the potential rate hike and ensure that your financial strategy remains on track. Furthermore, consider using the 50/30/20 rule to allocate your income towards necessities, discretionary spending, and savings, respectively. This will help you build a solid financial foundation and weather the potential storm of rising interest rates. In conclusion, the potential rate hike could have significant implications for your wallet. To recap, we discussed the impact on mortgage rates, credit card interest, and investment portfolios. And we provided actionable next steps to help you protect yourself from these changes. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about the Fed rate hike, hit subscribe. I break down one of these every week. As a final step, take a few minutes to review your financial strategy and make adjustments to account for the potential rate hike. By doing so, you'll be better equipped to navigate the changing financial landscape and achieve your long-term financial goals. Remember, staying informed and proactive is key to protecting your financial future. Take control of your finances today and ensure that you're prepared for whatever the future holds.